Have you ever stopped to think about what your money is getting you in return? It's not just about spending, it's about making smart decisions that bring value back to you. In this video, we'll break down return on investment (ROI) using a real-life example from the retail world. You might have heard of ROI before, but let's dive into what it means and how to calculate it in a simple way. Return on investment is a financial metric used to evaluate the efficiency of an investment or expense by comparing its cost to its return. It's like buying a product at a store. You want to know if the price is worth paying for the value you get. Let's consider a scenario where a clothing retailer offers a 20% discount on a $100 shirt, but also includes a free pair of socks worth $15. First, let's look at the cost and return side by side. If you buy the shirt with the discount, you pay $80 for the shirt and get $15 worth of socks as a bonus. The total value is now $95, $80 for the shirt plus $15 for the socks. To calculate ROI, we need to compare this new total value to the original cost of $100. The formula for ROI is simple: gain cost/cost x 100%. Applying this to our example, the gain is $95 new total value and the cost is $100. So 95 100 equals $5. But since we're using the absolute value, we get a positive number for ROI calculation. 5 equals 5. Next, let's talk about how to interpret this result. An ROI of 5% might not seem impressive at first glance, but it means that for every dollar you spend on the shirt and socks combo, you're getting back $0.05 in value. This is a relatively low return, but if you think about it as a percentage of your initial investment, it's still a positive outcome. Finally, let's discuss how to apply this concept to real-life decisions. When considering an investment or purchase, ask yourself, what am I getting back for what I'm putting in? Look at the numbers and calculate the ROI. This will help you make informed choices that align with your financial goals. Quick recap: return on investment (ROI) is a measure of how efficiently an expense or investment yields returns. The formula involves comparing gain to cost, using absolute value for positive results. A low ROI doesn't necessarily mean a bad decision. It's about evaluating the return relative to the initial investment. Think twice before spending your hard-earned money. Consider what you're getting in return and make smart choices that bring value back to you. As we wrap up this video, remember, a little bit of financial literacy can go a long way in achieving your goals. Now that we've covered the basics of ROI, let's dive deeper into its applications in real-life scenarios. Imagine you're considering buying a new laptop for $1,200. The salesperson tells you that it comes with a 2-year warranty and a free antivirus software package worth $100. At first glance, this might seem like a great deal. However, to determine the true value of this purchase, we need to calculate the ROI. Let's assume that without the warranty and antivirus software, you would have spent an extra $200 on maintenance and security measures over the next 2 years. By including these costs in our calculation, we can see that the actual cost of owning this laptop is $1,400, $1,200 for the device plus $200 for maintenance and security. The gain from the warranty and antivirus software is $100. Using the ROI formula, we get gain cost/cost x 100% equals 100 the forfeit x 100% approximately 6.43%. This negative result might seem alarming at first, but it means that for every dollar you spend on this laptop, you're actually losing $0.0643 in value. Now, let's contrast this example with a different scenario. Suppose you invested $1,000 in a savings account earning 5% interest per annum. After 1 year, your investment would have grown to $1,050. To calculate the ROI for this investment, we use the same formula. Gain cost/cost x 100% equals $1,050 1,000 x 100% approximately 5%. As you can see, the ROI in this case is a positive 5%, which means that for every dollar you invested, you earn $0.05 in interest. This example illustrates how ROI can help you evaluate investments and make informed decisions. To further illustrate the importance of ROI, let's consider an example from everyday life. Imagine you're deciding whether to buy a coffee machine for your home office. The initial cost is $200, but it comes with a 2-year warranty and free maintenance services worth $50. To calculate the ROI, we need to determine the actual cost of owning this coffee machine. Assuming that without the warranty and maintenance services, you would have spent an extra $100 on repairs and maintenance over the next 2 years, the actual cost is $250 $200 for the device plus $50 for warranties. The gain from the free maintenance services is $50. Using the ROI formula, we get gain cost x 100% equals 50 x 100% approximately 16%. This negative result means that for every dollar you spend on this coffee machine, you're actually losing $0.16 in value. In contrast, if you bought a similar coffee machine without the warranty and maintenance services, the ROI would be more favorable. To apply these concepts to your own life, remember that ROI is not just about evaluating investments, it's also about making smart purchasing decisions. When considering any expense or investment, ask yourself, what am I getting back for what I'm putting in? Look at the numbers and calculate the ROI. This will help you make informed choices that align with your financial goals. In conclusion, ROI is a powerful tool for evaluating investments and expenses. By applying this concept to real-life scenarios, you can make smart decisions that bring value back to you. Whether it's investing in stocks or buying everyday items, remember to calculate the ROI before making any significant purchases. As we wrap up this video, I want to leave you with a challenge. Take some time to review your recent expenses and investments. Calculate their ROIs using the formula we discussed earlier. This will help you understand where your money is going and make adjustments to optimize your financial outcomes. Remember, financial literacy is key to achieving your goals. By mastering the basics of ROI, you'll be empowered to make informed decisions that bring value back to you. So, take control of your finances today and start making smart choices that align with your vision for a brighter future. In our next video, we'll explore more advanced concepts in finance and investing. Stay tuned for practical tips and insights on how to optimize your financial outcomes. Until then, keep learning and stay financially savvy. This is where the rubber meets the road. Applying ROI to everyday expenses can make a significant impact on your wallet. For instance, let's say you're considering buying a new smartphone with a 2-year contract. The upfront cost might be $800, but the monthly payments would be around $50 for 24 months. Using our ROI formula, we can calculate that the total cost of ownership is approximately $1,200. However, if you were to buy an identical phone without the contract, the price would be around $600. This means that by choosing the contract option, you're essentially paying an additional $600 in exchange for a potentially lower upfront cost. Another example is when it comes to credit cards. While they can offer rewards and cashback, the interest rates associated with them can quickly eat away at your savings. If you have a credit card with an APR of 18% and you carry a balance of $1,000, the annual interest charges would be around $180. This is essentially a loss of value, as you're not earning any rewards or benefits from carrying this debt. To illustrate these concepts in real-life scenarios, consider a friend who invested in a timeshare to vacation annually. At first glance, it might seem like a great deal, a guaranteed week-long vacation every year for a fixed price. However, upon closer inspection, you realize that the total cost of ownership is much higher than the initial purchase price. Additionally, the quality of the accommodations and services may not be what you expect, leaving you feeling disappointed and overcharged. These examples demonstrate how ROI can help us identify opportunities to optimize our spending and investments. By applying this concept, we can make more informed decisions that align with our financial goals and values. In our next video, we'll delve into more advanced concepts in finance, such as compound interest and risk management, to further empower you to take control of your finances.